Okay, let's get into it. So if you look at your business as a value chain, you have a supplier that you get your raw material from. You then input that into your business, add value to it. You will then get an output by moving that through a process, and then your customer will receive the final product or service. So adding value really means taking raw material, following your internal process to transform it so that the finished product has more benefit or more value to your customer than it did when it started off as just a raw material. And that's really what costing and pricing is about. It's about trying to calculate and discover what you should charge for the added value. For services, it's a little bit different, and their value is mostly spent on the time you would put into the service offering or the objectives that you'll be meeting for the client. Okay, so there are a few things that affect costs. The first one could be your labor, which we just mentioned with the service. You also have the material that you purchase from your suppliers. You need to transport that material from your supplier to your place of work where you're adding the value. Sometimes you need to buy material up front and keep it somewhere. So there's also a cost incurred in carrying stock. And often there's also a cost incurred in ordering stock. Prices change over time. You're using your phone, your time to get quotes, and all of that adds cost. And then, of course, you need to get your product or your finished goods to your client, and there's a transport cost involved in that. So just keep that in mind as we go through the webinar and as you calculate your costs, that these are also sometimes things we don't always think about. Some other things to consider is, will your suppliers be delivering the material to you, or will you be collecting the material from them? Will you order up front or only once you receive an order from a customer, as this can affect your cash flow and also whether or not you'll need a premises to store the material? If you order up front, you need to think about where you will store it. Is it somewhere that you own, that you rent? Is it just in your house? How will that work? And then, of course, what payment terms you need to negotiate with your suppliers. So some suppliers like to be paid cash on delivery. Others, if you built up a relationship with them, will give you an account or credit, which could be 30 days or 60 days, depending. So ideally, what you'd like to do is get some kind of deposit or payment from your customer and use that to pay your supplier at a later date, because that will help your cash flow too. Then, of course, whether or not you have to deliver your products to your customers, and if so, who will be carrying the cost of that? Will you include it in your price, or will you get the customer to pay an additional transport fee? If you are delivering services, you need to think about things like whether or not your customers will come to you. Will you go to their premises? Will you offer the service online? And are there any costs incurred in doing that? Okay, so let's get into product or service pricing. So as I've said here, and I think a lot of businesses do this, they will compare their prices to their competitors' prices and just make it slightly cheaper and go to market with that price. The danger in that is that you still need to make sure that what your customers are paying does not result in you losing money. So, for example, your competitor could have different costs to you. They might have cheaper suppliers. They might be using an lesser quality material, and therefore they're able to charge less for the product. But you might be using a better quality. You might be paying more to your suppliers. So simply comparing your price to your competitors is not the only way that you should calculate your prices. So I've said here that determining what you actually need to charge for your products and services consists of 3 factors. So the first one is direct costs, which I'll be explaining to you. You also have your indirect costs, and then you have your profit or your markup that you'll be adding. So the first one, if we look at direct costs, and I've just separated products and services because they're a bit different. But for businesses that offer services, the cost price will be the time that you spend on the service for the customer. And often this is expressed as a rate per hour. So I've put an example here for someone who works from 8 in the morning to 5 in the afternoon, from Monday to Friday for 4 weeks a month. You would calculate your cost per hour with the following formula. So you would take the amount that you want to earn per month, or your monthly salary amount, or even the income for your business as a whole, and you would divide that by 4.33, which is the weeks in a month. The reason why it's 4.33 is because not all months have a full 4 weeks. So as we know, February has fewer days, some months have 31 days, some months have 30. So averaged out over the year, it would be 4.33 weeks in a month. And then you divide that by the hours per week. So typically someone would work 40 hours a week. And that will give you your hourly rate. So what I've done here, I'll just give you 2 minutes to calculate this for yourself. You can take what you like to earn in a month, or what your business should be bringing in a month, and divide that by 4.33 and divide that by 40. And that will give you an idea of the hourly rate that you should be charging customers. Now, as I said earlier, you might need to also look at your competitors and different pricing strategies and what the market will tolerate within your industry for your set of expertise and the service that you're offering. But at least this gives you an idea of your cost. So one thing I do want to say here with services that you need to think about is that you are not always fully booked for 8 hours a day or for 9 hours a day. So that's something to bear in mind. You might not be working a full 40 hours a week or 160 hours a month. You might only have 3 or 4 hours worth of work per day. So just bear that in mind as you go about pricing your service. Then to move on to the direct costs for products. So here I've said that direct costs are the costs that are incurred in making or buying the product. So it's a combination of the prices for every single component that goes into that item. In order to calculate your direct costs, you need to have a very clear idea of the components of the product or service that you're offering, and what measure of each component you use, and how much each measurement costs. So I've given you an example of, I just chose somebody who makes cakes in their business. So perhaps you have a baking business and you need to find out exactly what your direct costs are for one cake. So let's say you go and buy all of your ingredients and you only use a portion of those ingredients in making your cake. So you might buy a kilogram of flour, which costs you 20 Rand, but in one cake, you only use 250 grams of flour. So that would be 20 Rand divided by 4, because there's 4 times 250 grams in a kilogram of flour. And that would give you 5 Rands worth of flour for one cake. The same with your eggs. And I know eggs aren't this cheap now with all the bird flu, but let's say 6 eggs cost you 12 Rand. But to make one cake, you only use 2 eggs. So that would be 4 Rand for the 2 eggs. And so you can continue through the ingredients. We've got sugar, baking powder, even electricity, because that's directly related to making your cake, and your labor. So in this case, your labor is different from a salary in the business. So let's say you've got a baking business and you employ an admin person. You don't add their labor or salary into your direct costs because they're not there physically baking the cake. But if it's somebody physically involved in actually making the product, you can include the labor as a cost of sale. So just think of that and how it applies to your business. So as you can see, we've added everything up, and the total direct cost for baking a cake is 244 Rand. So again, I'm going to give you a few minutes now for you to just take one product in your business, or perhaps if you've got a service business, you can work on that and calculate exactly how much the direct cost is of making that one product. Down to the cent of how you divide up your raw material, your labor, electricity, transport perhaps is applicable to you. So I know I said I would only address questions at the end, but I think this one will assist Cheryl Ann to calculate her direct cost as you're doing this exercise. So she's asked, what if you work on per number, example, training per student? So Cheryl Ann, you would typically look at, let's say, your rate per day, for example. So let's say you want to earn 3,000 Rand per day and the training takes a day. You could then calculate, well, how many students do you need to be there to make it worthwhile, and divide your 3,000 Rand up per student. But I mean, it depends if more students are going to cost you more money. So for example, if you need to print learning material per student, that's a direct cost. But if there's no learning or training material, and whether there's 5 or 10 students attending your training, you might just want to charge a flat fee for the day, in which case you would work out how many hours you're spending there and what you'd like to charge. So I hope that answers your question there. Okay, so I hope that you've all calculated your direct costs, and I'm now going to move on to the next section, which is all about your indirect costs. So indirect costs are often something that business owners forget about or forget to pass on to the customer. So these are costs that must be covered every month, regardless of whether you sell one item or 1,000 items. So examples of indirect costs are rent, your electricity and water, your phone bill, the data you need to buy, salaries you need to pay, like for example, earlier I used the admin lady, stationery, marketing, accounting, insurance. These are all direct costs in your business, and they are not relevant, or they don't relate to the number of customers you have. So for example, your rent will stay 5,000 Rand a month, whether you have 10 or 100 customers, and that kind of thing. But what we often forget is when we charge customers, we only think about charging them for direct costs. And then the indirect costs eat up all our profit. And at the end of the month, we can't understand why there's no money in the bank. So in the calculations and things that we'll be covering today, I'll be showing you how you can actually include your indirect costs in your calculations so that you make sure that those are covered too. So what I need you to do now is to quickly make a list of all of the indirect costs in your business that you expect to have every month, and write down the indirect cost and the amount that you pay for that per month. So for example, electricity, 5,000 Rand, phone bill, 500 Rand, data, 200 Rand, salaries, 10,000 Rand. whatever the case might be, but the cost must be per month. So unlike with the indirect costs, we're not dividing it up per service or per product or per hour. It's just the total amount that you pay for the month. And then I need you to add all of those up so that you have the total cost per month of your indirect costs in your business. Okay, good. And I know that things like your cell phone bill might change slightly. You know, 1 month you might make more calls, 1 month less. But if you could just think of what it is on average every month. You know, 1 month you might buy stationery and then you don't buy it again for 6 months. Or some months you might spend more on marketing. But just think about the average amount that you spend every month and the debit orders that go off your business bank account. So in doing that, you should now have a total that you spend on indirect costs every month. Okay, the next part that we'll be tackling is markup. So in order to determine the selling price of a product, businesses usually add a markup to their direct costs so that every sale contributes to covering the indirect cost of the business. So remember, when calculating your direct cost, it's your labor or the material that's involved in making the product, but it doesn't cover your cell phone, your rent, and all of that. So that is why you add a markup to cover your indirect costs, but also bearing in mind that your markup needs to enable you to make a profit. So we're all in business to make a profit. We don't just want to break even every month and cover our costs. Otherwise, our businesses won't grow. And you're basically working for free. So we want to make sure that you cover your indirect costs, but that you also make enough to make a profit. So the markup percentage that you choose to use in your business will be informed by a few different things. So the first one is the supplier prices that you're paying for your material. Another thing you need to think about is the market or industry averages. So this is particularly important when you are perhaps responding to an RFQ, a request for quote, or maybe a tender. You really need to think about what are the market or industry averages, as well as what you're paying the suppliers for the raw material. And then, of course, your own pricing strategy needs to come into play. Now, there are a few pricing strategies that I want to cover with you today. There are more than these, but these are the main ones that I picked out that I thought would be applicable. So the first one is value pricing, and we've spoken a bit about this already. So value pricing is used when competition is quite tough in an industry, and you need to make sure that people buy your product or service. So what you try and do is you try and make it slightly cheaper than your competitors. But just a word of caution on value pricing is you need to make sure that this doesn't become a price war with your competitors. So, you know, you might lower your price, then they lower their price, and then you need to lower your price even more. And at the end of the day, you're not making any money just because you're looking to beat your competitors on price. So that's value pricing. Premium pricing is used when the product or service you are selling is so unusual or so special that customers are prepared to pay very high prices for it. So an example might be a super rare handbag, and only 5 of them were ever made by Louis Vuitton, for example. You can charge a premium for that because there's so much value and it's so unique that customers are willing to pay more. Penetration pricing is often used by companies when you're introducing a new product to the market. So you all know washing powder, and an example of this is when Ariel sort of started in the industry to sell their washing powder, not power. I'm thinking of Vanish Power O2. They actually had to compete with Omo and Skip, were already quite embedded in the market and had a large market share. So what they did was they set their price very low in the beginning and probably made a loss and lost a lot of profit. But that enabled clients or customers to try the new washing powder. And once they liked it and they'd adopted it, then Ariel could increase their prices after a while in line with Omo and Skip and their costs. And people still bought it because they liked it. So that is penetration pricing. Then price skimming is used to charge high prices for new products. So you might know when, for example, the iPhone, I don't even know what we're on now, 13, 14, 15 comes out, everybody wants to be the first person to have it. They're queuing up outside the Apple store, and you can charge a lot more in the beginning for that product. And then what you do over time, it becomes a little bit cheaper. So that is your price skimming. Psychological pricing, you're probably familiar with, where, for example, you might charge 499 Rand for something instead of 500 Rand. If you think about it, it's only 1 Rand cheaper, but 499 sounds a lot better than 500 in our minds. So when you're pricing your products or services, also think about the psychological effect of having something, I almost want to say like one price bracket lower without too much effect on your profit. Then, of course, you get promotional pricing, which could be used to get or to grab the customer's attention. So I'm sure you've all been into Clicks where they have their 2 for 3 specials, and that's an example of promotional pricing. So this could also be a strategy that you use in your business. And a very important one is bundle pricing. So in bundle pricing, you often use it to upsell your product. So let's say you have a beauty salon and you're selling skincare products, and you've got a toner, a moisturizer, and a face wash. Each of those might be more expensive individually, but as a bundle, they might be a bit cheaper. So you are actually incentivizing the customer to buy more from you because they get a better deal overall. So that is your bundle pricing. So when you are adding your markup to your product or service, these are the types of strategies you need to think about. Am I doing skimming? Am I doing penetration pricing? Am I offering a promotion? And how does that affect my product? Oh, sorry, not my product, my costs and my pricing. Okay, so this is where the rubber hits the road, calculating your actual selling price. So there's a formula that you can use to calculate your selling price, and that is you take your direct costs that you calculated. So in the example I used, it was 244 Rand for the cake. And then you add direct cost multiplied by the markup percentage you choose. So when you are doing your markup calculations, it's common for you to use standard percentages across all items. So for example, 25%, 50%, 75%, 100%. But you could really mark up your product or your service to whatever percentage works for your business. And you might find that some of your products or services have a different markup to others for whatever reason that might be. It could be a pricing strategy. Maybe you're trying penetration pricing with a new product, so you mark that up lower. But an established product that people love, that they've been using for a long time, you might mark up by 50 or 75%. So it really just depends on your business and your strategy. The percentage you decide on will inform the calculation you use to work out your selling price. So I've got an example here. If we continue with the baking, Temba worked out that the direct cost of baking his cake is 244 Rand. So he's decided, given his pricing strategy and the profit he wants to make, that he's going to add a 50% markup to his costs to get to his selling price. So to help him figure out the rand value of the selling price, we can make the following calculation. So his direct cost was 244 Rand. And if we add that to his direct cost times a 50% markup, that will give you 122 Rand. So the total price that he will charge for his cake is 366 Rand. And bearing in mind that that 50% markup needs to cover his indirect costs, and it also needs to cover his profit that he's looking to make. So I'm going to ask you to do this calculation now. And I've said there, you can calculate the selling price of just one of your products at a 50% markup. But you're welcome to play around with it and use any percentage you like. Or perhaps you want to do different calculations. So maybe you want to calculate the selling price at a 25% markup, a 50% markup, and a 75% markup, so that you can see what the difference will be and kind of in your mind know whether the market will tolerate that. How does it compare to your competitors? And are you making enough profit in doing that? Remember to be using the direct cost that you calculated earlier for your product and the markup percentage that you think will cover your indirect costs and still make a profit. So what we'll be doing next is using this information in what we call a break-even analysis. So here I've just given you a definition of break-even, which is the amount of units you will need to sell, or in other words, the money you need to make to cover all of your costs before you make any profit. So really you want to see how many units of a product you need to sell in a month to cover your costs. And then you know that anything over and above that will contribute to your product, to your profit. So in the formula is break-even units equals total indirect costs. So remember earlier you calculated your indirect costs, which were things like rent, salaries, cell phone bill, electricity. You would take that total amount per month and divide that by the selling price of one of your products. So the indirect cost is your monthly cost for everything. The selling price is a cost per product. And from the selling price, you would subtract the direct cost per product. So I'm going to give you an example, continuing with the cake bakery business. Let's say that Themba's total indirect costs for rent, salaries, cell phone, etc. per month is 10,000 Rand. You would put that in there. We saw that earlier we calculated his selling price with a 50% markup at 366 Rand. And the direct costs of all the ingredients that he bought to make his cake is 244 Rand. So you would then say 366 minus 244 is your 122 Rand. And that is divided into your total indirect costs for the month. So in Themba's case, he needs to bake 82 cakes a month before he even makes a profit. So you might see that and go, okay, that's totally doable. Or maybe, you know, that's way too many at the moment. I can only bake 5 cakes a week. So what can you do about that? You then need to go and look at your calculation and say, well, either my total indirect costs are too high. So is there anything I can do about the amount of rent I pay, the amount I'm spending on my cell phone, my transport costs, my data costs, whatever the case might be? If yes, you can make those adjustments. But if no, then the only way to change your break even is to change your selling price and make it a bit more expensive, which means increasing your markup percentage. So perhaps you don't use 50%, you might use 75% or 100%. Or on the direct cost side, you could go and see, well, is there anything I can do about my supplier prices? Is there anywhere where I can get cheaper eggs and flour and sugar to bring the direct cost of my product down? So I've given you a few minutes here to calculate for one of your products how many break-even units you need to sell per month. But what you can do while you're calculating this is actually play around with your selling price. So, you know, you might say, okay, I'm not going to use a 50% mark. I'm going to use a 75%, and see how that brings down your break-even units. So let's say Themba sold his cakes for 400 Rand. He might only need to sell 60 cakes a month or 40 cakes a month. And then again, to bear in mind, you can't just increase your prices so that you don't need to sell as many per month. You obviously need to go back and think, what are my competitors selling their cakes for? What will the market tolerate? What is my pricing strategy? And those kinds of things. And then, of course, is it doable capacity-wise to be able to be selling this much? If not, what can I do about it? So another thing that might affect your break-even or your pricing is whether or not you are involved in a business where you can sell at volume. So if you have a product where you can sell hundreds a month, then you can afford to charge less per product because you're working on volume. But if you're only selling 2 very expensive handbags per month, then obviously you need to make more per handbag, if that makes sense. So I'm just going to give you 2 more minutes to calculate the break even for one of your products and see how many units you actually need to sell per month to cover your costs. So somebody is asking, Tabang, does this principle apply to tender pricing? So I want to say yes, Tabang, but with tenders, you know, you need to be a bit careful because price is really one of the only things that you're competing on, apart from maybe your BE level or the locality of your business. So it's important to go, well, what is the volume or the total amount of this tender? Because if it's R1 million, you can afford to mark it up by less, by maybe 10% or 15%. But if it's a tender for 300,000 Rand, you know, you might want to add 20%. But yes, the same principles apply. You need to know what it's costing you from your suppliers and the indirect costs involved in your business. Because if you're only going in cheaper to beat the competitor so that you can get the tender, then you might find you fulfill the tender and you actually run at a loss or you don't make any money at all. So I hope that helps. So yes, Rick has made a comment. He said, this is enormously valuable. Arriving at a profitable selling price is a major challenge for most of his clients. And he suggested that I have a basic spreadsheet template. So Rick, I actually do have that. And anyone who actually attends a mentoring session with me, I provide them with a template which they fill in and it automatically calculates all these things for them. So yes, thank you for that. Okay, Eric wants to know if you could say your selling price is your direct cost plus your indirect cost times your markup. You could, Eric, but remember your direct cost is per month and your indirect cost, your direct cost is per product and your indirect cost is per month. So that would probably skew your formula and your calculations a bit. So I know that's for selling price, but for break even, you would need to stick to looking at your indirect costs per month and your direct costs per product. But yeah, just go and play around with it and see what different values you might get. Okay, so I know I've been talking a lot while the calculators are going, but hopefully you've managed to calculate your break even for one product. Thank you so much for your time and for attending. And I really hope that this has added value to your business and that you have a bit more clarity on what you should be charging. And yeah, I look forward to business growth and success and all of those good things that I wish for you.